Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, April 4th, 5:04 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend, still excluding financials and real estate from that as those have not been acting well at all. Real estate bouncing back a little bit, but we might be adding some additional sectors to the avoid list. We'll get into that when I get into the charts. Check over here on the trend gauge. Trend gauge leaders still acting fine. 21-day moving average. We had all five of the indexes make at least two closes above yesterday. Big negative reversal today on mid caps and small caps. They closed back below the 21, so the yellow sub arrow has come out. The three big cap indexes are still firmly above the 21. Medium term, we're at neutral again with the 50-day moving average. The S&P, the Nasdaq, and the Dow are above. The mid cap and small cap are below. Long term, also flashing neutral. Three big cap indexes above the 200-day moving average. Mid caps, I believe, pulled back and are sitting right on it now. So what happened today? We started out with a mild gap up and going sideways. There was some data that came out at 10 o'clock, and the initial reaction to that data was higher. It was JOLTS data, or job openings, and the job openings were lower than expected, which you would think would be a sign, a benefit to the market, because weak economic data is an indication that the Fed may be finished raising rates. However, weak economic data is also a sign that the recession may be imminent. So we've been kind of ignoring all the calls for the recession lately with the rally off of the lows and the strong moves in several sectors. But uh, today, and maybe it's one day, today changed some of that. And we're going to take a look at how industrials, retail, transports got hit after 10 o'clock when this data came out. We also had some weak manufacturing data yesterday. So that's two consecutive days of data that is not beneficial to the health of the overall economy. We've also had the Atlanta Fed slash their Q1 GDP from 3.2 to 1.7 over the last 2 weeks. So whatever inputs they have that goes into that graph that they create, the data has not been good. That's a pretty big cut in 2 weeks from GDP. So it appears as though we may be starting to look for recession resistant sectors. And we'll get into that when we look at the charts. Final numbers on the day. RG7, this is our 7 ETF growth composite, down 1.5. The best performing was ARK-K. The other six took it on the chin. S&P 500 rallied, let's see, about 14, so about a quarter percent off the low after a 0.2% gap up. Finished right at 4101, down 0.6%. NASDAQ 100 down 0.34. Dow down 0.6. Mid caps down 1.7. Russell 2000 down 1.8. Global Diversified 6040 down 0.11 as bond prices rallied, meaning interest rates coming off, which is consistent with what the market has been pricing in. In-house GROTECTION down 0.83%. One of our positions got hit by a report from a short seller, and we'll get into that too. So let's dive into the charts. We'll start off with the S&P 500. Relative to where we've gone lately over the last 8 sessions, this pullback really doesn't mean much. But when we go to the tail of the tape and we dive into some individual sectors, you'll see why today at least raised a few concerns. Overall on the index itself, not a big deal. Mild pullback, and the leaders were down, but most down on extremely light volume. So that didn't really cause me much, if any, alarm either. So there's the S&P 500 mild pullback, Nasdaq 100, the leader. Second day inside the candle from 2 days ago, not a true inside day, but it's doing what it needs to do, and that's relax up here after a strong move off the lows. I mean, three things that are certain in life are death, taxes, and regression to the mean in the stock market. So when you get extended at some point, you know you're coming back to more normal returns. Let's go to the Dow. For an industrial, it didn't get hit as much today. For an industrial index, it didn't get hit as hard today as some of the true industrial stocks did, down 0.59 on the day. Actually, an inside candle still holding above the 50-day moving average. And then we've got mid and small. And, if these are down and lagging, that probably means the banks did not have a good day. And that's also true today. So the mid caps did hold. The 200-day moving average closed right below the 21-day moving average. Here's IWM. Uh, that looks awful. Would have been a good short on a break back below the 21. Let's go to uh, some of we'll go to the financials because we've been touching on these with the bank crisis. But this wedge up into the 21, I talked about it last week. FAZ would have been a really nice play today on a fail at the 21. Let's look at the banking sectors. KBE, this is includes some bigger banks here. Not good, getting nowhere near the 21-day moving average and breaking back below the 8. And then even worse is KRE, not quite new closing lows, but if we thought this was behind us, the action of the stocks and these indexes is telling us it's not behind us. You can see this coming off of lows on coming off of oversold, hooked immediately right back down as soon as it got into the not oversold area. So not a good look there for regional banks at all. Let's go to the dollar. Dollar weakness continues. In fact, a new closing low for the dollar index going back to the beginning of February. Uh, Continues to trend below the ADMA and is very oversold. How about the VIX? VIX slightly higher, 20 at the high of the day. Not much to report there. And again, it is oversold. Let's flip to bonds now, the broad bond index BND. And at 10 o'clock, let's look at a 5-minute chart here. All the bonds took off like this to the upside. Remember, price up means yield down. Uh, Look at the same thing that happened yesterday at 10 o'clock when that ISM data came out. Price up means yield down. Yield down is in keeping with the theory that the Fed is going to chill a little bit on their interest rates, but if they are, that means the economy's weaker. So it's a pick your poison type thing. Corporate bonds, LQD, also slightly up on the day. TLT, the long-term bond up 0.5%, back above the 200-day moving average. Let's go to the yields first. TNX, the 10-year down at 2.71%. In fact, lower now than what looked like this shakeout from 2 weeks ago. So that's kind of significant to me anyway. When you look like that, because the old saying, from failed moves come fast moves, and that's what we look like was happening. But the last 2 days, go to the 10 o'clock chart on the 5-minute, you can see yields falling, yields falling. It might be time to put some funds into not just the bond, the T-bills that we have, but possibly into bond indexes too, should that trend continue. Let's go to TYX, the 30-year, down near, not breaking below the lows of this. In fact, that shakeout was 2 weeks ago, not 1 week ago for the 30-year, but it is a approximate 2-week low on the 30-year. Now, with the dollar down, what do you think gold and silver did? Are they keeping the inverse correlation? You bet they are. Gold breaking out up 1.9% on the day. Gold stocks, GDX, even stronger, up 3.4% on the day, new highs from this correction. And silver joined the party today with a breakout, up 4.1%. Definitely something to pay attention to. Bitcoin, uh, Still consolidating in a tight 2 week, coming off of overbought, not signaling risk on. This kind of stays somewhat in sync with the Nasdaq 100. So those are the major indexes that we check. Now let's dive into these recessionary sectors that I'm talking about. You can freeze this if you want to read the whole thing. But JOLTS data weaker than expected sparks recession sectors sell off. So think of this as sectors that are susceptible to really getting hit by a recession. First off, the day count up 6 out of 8 now, 8 days above the 80 EMA and the 21 EMA. With that data today, the odds of no increase raised to 61%, up, I think it was, let's see what it was yesterday. It was at 45%, so not an insignificant gain. Still above the 21 EMA. Support resistance levels held on the Nasdaq and the S&P 500. Here's the intraday action, 10 o'clock. Critical. Let's go to S&P, and you can see this false breakout that I'm talking about on the initial reaction. So here we are. We go down 10 o'clock. Here's a failed breakout. Now, when you're already extended to the upside, anytime you make a higher high on the indexes, it's not something to celebrate because, as I said, we know we're going to regress to the mean at some point. But what this turned out was a false breakout to new recent highs, then a little bit of a bear flag before we started breaking down at 1020, and that breakdown devolved into a sell-off from 41.33 to 40.86, over 1%, before we bottomed a little after lunchtime and then kind of sideways into the close. But you're going to see, I'm going to go through some sectors in a little bit, and you're going to see how they really got hit hard. So the only sectors up on the day: utilities, gold and silver stocks, and bond prices. On the downside, oils, semiconductors, which are considered a cyclical, KRE, regional banks, XLB, basic materials, F, financials, I, industrials, transports, XBI, also retail in here. Yes, I don't want to exclude that because I've got a stock I'm going to show you. So here is our focus list, which is what we own. The things highlighted in yellow we took off today, and we had a bad experience with AI. So we added and then trimmed down to a very small remaining position in AI, and we sold Tesla, locked in a small gain. It just hasn't been acting well since that. In fact, it's a failed breakout since they reported that sales. And the volume hasn't exactly been light. Still sitting on the 21, but failed breakout. I don't think it's quite hit the loss yet, but we wanted to lock in our gains also, coming off of overbought, failed breakout, still below the 200. Small gains we ended up locking in on this when we bought it back here when it got back above the 21E. And then nail, here's ITB, and you can see the breakout. We've been talking about this. This was a pretty hard reversal, down 1.79%. Now the home builders themselves didn't, but there's a lot of uh, building type components inside of ITB that did not look good at all on the charts, and it's big enough of an impact to me that I don't want to be messing with this. If I want to play a home builder, I can. But nail is what we actually ended up selling. That's a 3 times ITB when we got back to break even after the gains evaporated in one day. So um, nail gone, Tesla gone, AI trimmed, uh, Revere volatility adjusted beta down from 1.63 to 1.43. Here's the deal with AI, and this really looks ugly. Uh, it was up pre-market, gapping up again, and then a short seller came out with a report. The short seller tried this a couple of weeks ago, and at first it really didn't catch on at all. And the fact that what I was reading up about it was that this guy already tried this, and now he said he sent a letter to the SEC. This isn't the SEC sending the letter to AI. So it was a little bit of a gap down, but it didn't seem to be doing anything. But then, and when it gapped down, it gapped right into this 30 area, which had been a pretty good support area, and we added 1% to it. But then it started breaking lower. We took off the 2% that we bought yesterday, and we sold half of what we bought early in the day. So we went from 3% by the end of the day down to a 0.5% on this. Uh, Still a very manageable hit to the portfolio, a little bit more than I would like, obviously, to have given back, but um, at what first sounded seemed like it was really no big deal, turned into quite a big deal by the end of the day, down 26%. So bottom line for today, 10 a.m. JOLTS data raises recession fears, hits industrials, financials, retail. There's some stocks here that I'm going to bring up. And the leaders really, like I said, not hit much on the day. What we still own in house, volume down 40% versus average. So normal pullbacks still, but we did get rid of Tesla and now. So here's what I want to show first. This is XLI. Industrials. This is not a good looking candle. Anytime you give back 4 days worth of gains in one day, you've got to be concerned about it. That's a big move to the downside. Volume above average. So this was a sector that had been up uh, 7 straight days, but a normal pullback's okay. The indices themselves have been having normal pullbacks. This isn't a normal pullback. This is a little more to be worried about. Maybe it's one day and it rights itself and gets it back tomorrow, but when sometimes 2 plus 2 does equal 4 in the market. And when you get something and you expect it to impact something, and that impact is more forceful than you would expect it to be, ignoring it is probably not the right move. So let's go to some industrial stocks and you tell me if this looks normal. There's Caterpillar, 6 up days, down 5.4%. That says recession. John Deere, down 4.8%, not a good looking candle. And these are things that are susceptible to recessions. GE, this may be a top in GE, down 1.93%, but this had been one of the best looking stocks, and it's one that I'll be keeping an eye on to see if this deteriorates anymore, these recession type stocks. Steel, 7 days up, gave back most of it, down 4%. How about some individual steel stocks? Here's Nucor, brutal. Gave up the entire recent move. Wasn't a leading stock to begin with, but this isn't what you want to see. This may be an overreaction, or it may be serious rotation out of these and into things like staples, utilities, and ironically, the big cap tech stocks, which again held up today more than the average stock. Here's another one, U.S. Steel. So it's consistent among the steel makers. Forget it. Let's look at SCCO, a leading copper stock. Try to break out yesterday, down 3% today. How about URI? They rent stuff. That's not a good candle, making new lows, down 7.7%. How about some retail? ASO, failed breakout, giving back the whole thing since its earnings gap up on higher volume, down 5.8%. Wing, leading retailer. Are people not going to eat chicken wings anymore if it's a recession? That down 6% on 40, on the heaviest volume going back to the earnings day. Some more than yellow flags, we're going to call them some red flags today in the reaction to what came out at 10 o'clock, piggybacked on some recently slowing data that came out yesterday too, and the cutback of Atlanta GDP. Let's look at the most defensive of sectors, XLP. Uh, this is where money is going to start flowing if people think that the recession might end up really being something. XLY, consumer discretionary, didn't really move today, but keep an eye on whether or not this breaks the 200-day moving average. I'm going to set an alert there right now for that. And again, we take it day by day. We don't predict. We see what happens, and we try to see if 2 plus 2 does equal 4, and it did today with the continued weakening economic data and hitting these recession susceptible sectors. And that's going to wrap it. As always, like to hear from you. Remember what we do at Revere. Avoiding these. Break below the 200-day moving average. That's when bear markets occur. We're below the 200 on mid caps and small caps, but we really don't have anything allocated to them. We're allocated to the leaders, a lot of tech leaders that have been acting well. Will people stop buying ON expensive running shoes? That chart says not yet, but we're always on guard in case it does. This is, our biggest position. It's been a massive gap up and just continued higher according to the blueprint that we follow. If it starts breaking the ADMA, we'll take some off and regroup and see what happens. But downside protection first in a healthy market and a bull market, which really we have been showing a lot of great signs of the bull market with this pullback and then breakout, two follow through days, huge breadth improvement. Last Wednesday and Friday, two tight inside days on the NASDAQ. A lot of good signs, but today, some little red flags waving, let's say that, and we're going to see if those flags get bigger. And that's going to wrap it. So, as always, love to hear from you. Don at RevereAsset.com. The phone is 855 Real Wealth. That's 855 732 5932. Stay away as of now. We're going to add industrials into this until we get some better signs that they're not going to get absolutely crushed. So, uh, the one that the thing one, there are a couple of them in there that just really got my attention today. They shouldn't have done it. Stocks should act a certain way. Pullback should be gentle. There's a difference between a pullback and a harsh sell-off. And some of these sell-offs are, as I said, harsher than they should be. And with that, I'm going to wrap it up for Tuesday, April 4th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.